In 2000, when you made the high, in January, the first trading day of that year, 2000, we put out a report that said, okay, be gone. Okay, you go a little bit further to the left there. Just prior to that drop, you see that it's right under the hand. There's a little drop there. Yeah, that was from January through February. And then you turned back up and made a new high in March. That's that peak candle there. Yeah. It wasn't major high, but it was a new high. And people said, oh, you see, you were wrong. And we said, no, this is a top anyway, because price may be doing this, making you tease you with a new high, marginal. But momentum says, no, you've broken the backbone of this beast, and therefore any rally you get is counter to the momentum trend. Okay, structural breakage, it wasn't corrected by that rally in March, but it made the longs feel very comfy. And if you look, it wasted the entire year of 2000 laboring either side of your first circle there, that little circle in January. I mean, it was up and down, but it wasn't going anywhere.
Michael kicks things off by stating that the next couple of quarters will be highly dynamic, not just in the usual hot sectors, but even in markets that have been dormant for years. But don't mistake dynamic for bullish. According to Oliver, this period is likely to expose deep structural weakness and catch many investors off guard. He draws immediate attention to the S&P 500, highlighting that he turned bearish back in early January 2025. At the time, the index made marginal new highs, but lacked the momentum strength to confirm a bullish breakout. It clustered sideways for months and then began to crack in February through April, following a familiar historical script. When the drop began, Oliver's team projected a bounce zone around 4,800, a key technical level last seen in 2022. His reasoning wasn't just about price memory. Momentum analysis suggested that the market would become oversold at that level, and even bear trends require corrective bounces. Sure enough, the bounce arrived, but what came next wasn't strength, it was deception.
I think that the next 6 months, the next couple of quarters are just going to be pretty dynamic in most markets, including some markets that have been dead asleep for a couple of years. I'll get into that in a minute, but stock market first. We turned bearish on the S&P in early January of 2005. And 2 weeks later, it went up and made a marginal new high. And it's clustered up there for quite a few months. You'll see it just sort of, new highs, but it really wasn't going anywhere. But anyway, it finally fell apart in February, March, April. Okay, and we had news at the tail end of that, the tariff stuff. Okay, fine. When the drop began, we put out a report projecting that there would be a bounce point, and the bounce point we projected would be 4,800 area. And the reason for that was back in 2022, there was a high at 4,800, and we figured the price guys would buy the old high. Okay, yeah, you see it there. Now, there's other reasons too. There wasn't just the silly price chart line across the thing. It was some momentum reasons said, no, when you get there, you're going to be oversold. You need to bounce. Even if you're in a bear trend, you get oversold from time to time. You need the correct upside.
Right.
And sure enough, it bounced, and we didn't project that it was going to make a new high. But we have focused on our prior history of stock market tops and what we've said and so forth. And when we go back to 2000, there are two major bull tops in the last 25 years. 2000, the dot-com high, and the other one was 2007, prior to the mortgage real estate crisis. In 2000, when you made the high, in January, the first trading day of that year, 2000, we put out a report that said, okay, be gone. Okay, you go a little bit further to the left there. Just prior to that drop, you see that it's right under the hand. There's a little drop there. Yeah, that was from January through February. And then you turned back up and made a new high in March. That's that peak candle there. Yeah. It wasn't major high, but it was a new high. And people said, oh, you see, you were wrong. And we said, no, this is a top anyway, because price may be doing this, making you tease you with a new high, marginal. But momentum says, no, you've broken the backbone of this beast, and therefore any rally you get is counter to the momentum trend. Okay. Structural breakage. It wasn't corrected by that rally in March, but it made the longs feel very comfy. And if you look, it wasted the entire year of 2000 laboring either side of your first circle there, that little circle in January. I mean, it was up and down, but it wasn't going anywhere. But yet it felt good because you'd made a new high. In fact, in August, on a monthly closing basis, that was a new high monthly close. It was only in the rollover there. See that first drop you see into early 2001? Yeah, let's start there. Yeah. That low that you see where there's a spike rally after that. Go further to your left, back over to take your crosshairs up to the left. Anyway, you got down to 1,300 and something and then bounced. That was a Fed rate cut. The first rate cut they'd had in over a year. They'd been in pause mode.
Oh, and here, back.
Yeah, no, further left. Yeah, here? Right there. That was a rally caused by a Fed rate cut. They had ceased cutting rates a year earlier. Okay. And it was in other words, you're in a pause. They came in January and said, oh, no, they cut rates twice that month, in fact. If you shorted into the rally that followed those rate cuts, you nailed it pretty good because then the bear market really started. Even in January of that year, 2001, you weren't really that far off the highs. People didn't realize you were in a bear market. It was only later in 2001 that you started to come apart. But they cut rates all the way down. But it commenced, the real bad part anyway of the bear market, commenced with the Fed cutting rates. It's like a tombstone. Okay. Then, yeah, you can go there.
Yeah, so there it is.
Yeah,
so
you see
the
they
bottom
started
chart
cutting.
here.
Yes, see, there was a plateau there where they ceased rate rises. And then they cut all the way down. And did that help the market? No, of course not. Okay. Now, when you go to 2007, and you can start in 2006, if you will, and go to 2007, you'll see further over 2006. Anyway, at the end of 2006, the market was in the 1300s, still below its 2000 price high, which had been 1550, okay, in the year 2000. You're still laboring your way back up there. It's now 6 years later. You've wasted, if you didn't get out in 2000 and avoid the bear market, you're still less than break even where you were in 2000. Okay, but all those years, you finally came up there, and in late 2006, we put out a report. It was in December of 2000. The price then was about 1,300 something. Okay. We said, you're going to top next year in a range between 1,550 and 1,600. In other words, we were suggesting that the top zone would be above the high in the year 2000, which had been 1,550. In other words, we said, you're going to go take out that old high and top. Well, that's kind of outlandish statement. You know, you break through an old high, you ought to go, right? Anyway, in the summer of 2007, there was a rally up marginally over 1,550. So that first rally there that dropped sharply. And then before the ultimate peak, there was a peak before that. That's in July. And you dropped into the summer, hard drop, and you started back up. And in September of 2007, reapproaching that same 1,550 level. Again, that's the high in July of 2007, and all the way back to the year 2000. The highs were 1,550, 1,550. You finally went up, Fed cut rates in September 2007, a surprise rate cut, by the way. And the market shot up for several weeks and made a new high in October of 2007 at 1,576. You know, precisely in the middle of our projected topping range. But when you look at a price chart, you'd say, well, that's impressive, because not only did you take out the summer high, which had been just above 1,550, but you also took out the year 2000 peak. So, wow, what a breakout. Taking out all highs of history, you're going to go, right? Well, they cut rates. You went up for about 3 weeks into October, and that was the end. It was a tombstone on the market. Okay. Not that it had to occur, but it did occur. Fed rate cut. Don't want Fed rate cuts, because that says the Fed is concerned about something.
Right.
Okay. Anyway, it really didn't get bloody until later in 2008, but it was an arduous top, just like 2007 was. Arm wrestling, marginal new high, oh boy, and finally a rate cut. Everything's great, right? Okay. Well, we're doing the same thing now. I mean, we basically made highs in late 2024, early 2025. We dropped into April, nice multi-month collapse, stopped at our bounce point, went further than we thought, made a new high, but now it reminds us of 2007. It reminds us of the marginal new highs in mid-2000. We don't trust this rally.
Another big red flag lies in the healthcare sector, which makes up roughly 10% of the S&P 500. Oliver notes that it's showing severe annual momentum breakdowns. Even if it doesn't get media attention, this structural failure has macro implications. But the real hidden time bomb? Commercial real estate. ETFs like RWR and VNQ, which track commercial property and REITs, have been anemic for years but are now sinking below key support levels. According to Oliver, commercial real estate is dangerously overleveraged, and many loans are maturing in 2025 and 2026. If this sector begins to default or deteriorate further, it could have knock-on effects across financial institutions, especially those heavily exposed to commercial debt. This, Oliver warns, is the kind of side event that could ambush markets while everyone is distracted by NVIDIA's price action.
And first off, it's not just the S&P has made new highs, marginal, a few percent above the 2025 early high. So is the NASDAQ 100. But so many indexes out there have not. Russell 2000's not even close. Dow's not even at a new high. So many sectors don't look right. And when you run the Mag 7, it's only like 2 or 3 of those guys are still what you could call Mag. The rest of them are sharply lagged in terms of being at or above new highs.
Which ones are the exceptions? Which ones are
well, I mean, Apple, Amazon, Google, they're not making new highs. Now, Meta is, I think, recently or close to it, and Microsoft and NVIDIA. Okay, right. Tesla is obviously off the list. You know, it's a 7, but it's in the hole. So you don't have a Mag 7 anymore. It's a joke. You got Mag 2 or 3. Okay, and then when you go to some key sectors, you don't have to punch them up. But this healthcare sector is blown massive annual momentum trend structure. It looks very sick. That's like 10% of the S&P. Commercial real estate. It's an important financial sector because if it has problems, large commercial real estate, banks are going to get kicked in the gut because they're the lenders. And sure enough, the commercial real estate market is looking suspiciously negative heavy, and nobody's noticing it.
But hasn't that been the case for a while now? For
yes, it's been the case for a while. But all of a sudden, like last week when we had this good shot up in the S&P, and then this week, the RWR was an ETF of the commercial real estate. VNQ is another. Had a real bad week last week.
What's it called? RDNR?
RWR. And it's been anemic for quite a while, and now it's even more anemic. But you could, I mean, you know,
the Wilshire ETF.
Yeah, I mean, you go back to, yeah, you could see what we are. Look at the high that occurred late in the year last year and early this year. It wasn't even a new high. It didn't match the S&P in 2022 when it took out its high in 2023 and 24. RWR only came back about halfway to its high that had occurred in 2022.
Right.
And now it's sinking down through even price supports. Now there's some momentum stuff that looks even worse than this. You can't have this happen. These are the huge property developers, shopping centers, factories, computer centers, and so forth that are, we're not talking residential here so much. And it's very weak, and I understand it's very heavily debt laden, and a lot of those debts are coming due this year and next. But anyway, it's something to watch on the side, because this is the kind of thing that ambushes you. Everybody's looking at NVIDIA. You know, they've given up on Apple, okay, and Amazon, okay, we'll forget them. They're just looking at NVIDIA now and maybe Microsoft. But even NVIDIA punched that guy up. I mean, go back to the left there. See that? We've been in a zone for quite a while here. You know, The real shot up in NVIDIA peaked in the summer of last year. So a year ago, and this is what's been going on for a year plus now. It's really not going up. In fact, MSA created a price chart tool. We don't use price too much, emphasize it too much, but you have a power thrust in NVIDIA there, particularly in the 23 to 24 area, where you went from like $40 up to 150, okay? A big surge. We call it the power surge with three humps. You'll see there's one peak, a second peak, and now a third peak. This third peak better not wane. It better launch and not be like the second peak, which when it took out the first peak didn't go anywhere. The third peak is the end. So you either launch here off the page or you start to ooze and wobble back down. And if you start to ooze and wobble back down, this is a major top.
So is this right here the first peak? Is that what you're talking about?
No. The first peak would be in your circled area over there. After the power thrust. Okay. The power thrust is when you went from nothing to something real fast, a huge up move. Okay. And then you started to level off, and you've made 3 peaks since you started to level off, each marginally higher than the prior one. It's got to sustain this time. If it doesn't sustain, I'm just talking price now. There's other momentum factors we're looking at. But if you wobble back off this high and you start to get back below 150, 140, that kind of thing, you've made a major top. And it wouldn't shock me you go to $50 on NVIDIA, prior support. Anyway, but the point being, here's one of your Mag 7, even it has a pattern that is not particularly attractive.
To wrap things up, Michael Oliver presents a convincing argument that we are currently living through a deceptive calm, a market environment where prices are teasing new highs, but momentum and breadth are painting a radically different picture. Whether it's the S&P 500, the Mag 7, healthcare, or commercial real estate, the signs are all pointing to fragility, not strength. He urges investors not to be lulled into complacency by marginal new highs or short-term Fed-driven rallies. Momentum has spoken, and it's not bullish. Please like and subscribe.